Time to see what's on the radar for Lorne Steinberg, the CFA and co-president at Lorne Steinberg Wealth Management. Now, of course, morning coffee. We're going to talk about Starbucks first. We were talking about Constellation's coming up, but that's the stock everybody seems to love to hate right now. But let's talk about Starbucks. A little coffee in the morning, get everybody going. What are you liking about it right now?
What we're really liking about Starbucks is they're now 15 months into their turnaround. You don't turn around these companies overnight. We think they're on absolutely the right track, that earnings bottomed out in 2025. We're looking for a big bump in earnings in 2026 and margins returning back to where they were by 2027. We first saw the early signs last quarter of a little tick up in same-store sales for the first time. They've offloaded their China business, which was a big pain point, into a joint venture where they're owning a chunk of it, but they're no longer running it, and they can focus themselves on the markets that are where they really see growth. The new CEO has done a good job. I happen to have checked out these stores on a regular basis, and you notice the change.
Research purely.
Exactly. You notice the change immediately. They've added an assistant manager to every store. The staff is friendlier. I've spoken to staff members. This company is poised to get back to where it was.
Is that a big expense to add an assistant manager?
It is an expense, and so their expenses per store have gone up. Starbucks has huge margins. Wouldn't be surprised to see some price increases as well, because the customer base is fairly price resistant. The person that wants their $7 pumpkin spice latte, if they spend an extra 40 cents, they will. Yeah. So we think they'll be able to offset that over the next couple of years, and which will drive margins up. But the key is same-store sales, and we do see that continuing to improve this year.
And now with China, they moved out of China. It was about 2-3 months ago, I believe, right?
Right. So exactly, they've cut their joint venture. They've got a good joint venture partner, and they can put their focus back to areas where they can make a huge difference.
And China feels like a market that you really want to have somebody on the inside.
They tried it on their own for a number of years. It worked well for a number of years. The problem is other competitors in China moved in with much cheaper products, and that finally just put too much pressure on the whole system.
So where are they focusing their growth then?
They're focusing, first of all, North America will always be a huge growth engine. Europe, listen, I've been to Starbucks everywhere in the world. It's incredible. I always say, not only is it the same coffee that is served to you, but it's served by the same happy university student. And they've done a fantastic job. They offer better benefits than every other fast food place. They keep their people, and the cost of hiring is lower at Starbucks because people stay longer.
Oh, okay. Let's move on. Let's get to Constellation. It's the stock that seems everybody wants to hate on right now, but yet they're good.
Constellation Software is one of the best, if not the best, performing Canadian stocks over the last 20 years. Just way outperformed the S&P 500 and the TSX, and suddenly off by 40%. It's a software company, but unlike the companies we think about, this company has made 800 acquisitions over the last 20 years. They buy all kinds of small niche little companies with $5 to $10 million of sales and don't really integrate them. They let them run on their own. So like a Microsoft will have no interest in these acquisitions. They run them more efficiently. What's happened is, people are afraid that AI is going to eat into some of their businesses, that organic growth is slowing, and the CEO that built this thing had to retire for health reasons. That being said, the existing team remains there. The focus remains on acquisitions in a very fragmented industry. And so this is something we're looking at.
Is it possible they're running out of things to buy?
We thought of that. And it's possible. It's part of our research is looking at the fragmentation of this industry. Is it as fragmented as it used to be? Or has too much consolidation gone on and there are fewer opportunities? Because for this company, if there aren't acquisitions to make, the stock is worth less than it's trading for.
And then with AI, have you looked at what kind of are they incorporating it? Can they incorporate it? Does it seem like they'll be able to?
Everybody will incorporate it to some degree. The issue is, will it drive prices down for software, and will a lot of the users be able to integrate AI and not need as much of this software? Or be able to use more off-the-shelf software, which will knock out a lot of these niche businesses. Okay. But we think we're a long way from that.
Okay, we're almost out of time, but you can do one line on why you like Disney.
We like Disney because streaming has returned to finally become profitable, free cash flow positive, double-digit earnings growth.
All right, we'll leave it